Markets are awaiting key jobs data. The Street's looking for 190,000 jobs that were added last month. Let's bring in Michelle Girard, head of U.S. coverage at NatWest, as well as the CEO of NatWest Markets. And Michelle, we've already, I didn't say everything that you're thinking, but I did mention a couple of things. So I think you're a little below that. You're at 185.
We're right at 190. So
you're at 190. You're above then, and maybe the consensus.
Yes, slightly.
This is versus 175 last time, and you point out down from what was the average in the first quarter, quite a bit higher. It was in the twos.
Yes, year to date, we're running 246,000, in payroll gains per month. So this would be a solid number, but slower than what we've seen, slower than what we saw in the second half of last year. The trend is moving in the direction the Fed would like to see. It's probably got further to go. You talked about the fact we do expect the numbers will continue to weaken as we move over the remainder of the year. In general, the economy, we think, will slow, really pretty much stagnate over the second half of 2024.
Moving the Fed's way.
Well, they'd like to see it moderate, right?
Right. Well, I don't know. That's just implying that this means cooler inflation data, and I don't know. Is it like night follows day? It's weird to try to. It's weird to try to cause higher unemployment.
Exactly. Although, I don't think the Fed is necessarily trying to force the economy into a recession, but they don't want the economy to continue to grow at such a rapid pace and an above trend rate that you really can't get the inflation rate back to target. And they do make the connection that a strong job market will mean stronger wage growth, which will keep inflation elevated. So to see employment easing back a bit, and more importantly, to see the earnings numbers, wages numbers slowing from, what had been 4% plus. Now we think it's, it moved to 3.9%. To see some of the boil coming off in terms of the wage numbers will give the Fed confidence that, in terms of everything aligning for inflation to move back to 2%, that won't be something that keeps inflation elevated.
I surmise from what you're expecting in the second half that you think that we are in restrictive territory. So you expect 160,000 in the second quarter, and then a sharp slowdown from that in the second half in jobs?
Yeah. Yes, because, we do think that, where the monetary posture is with the funds rate over, 5%, that we are restrictive. And we do think that is having an impact and weighing on the economy. Although, George, you were talking about, it isn't easy to find the strong evidence of that, particularly when it comes to the labor market. Although some of the underlying data, everybody's talking about, of course, the number of job vacancies or job openings that have come off. You've noted the very modest uptick in claims. Small business surveys have suggested hiring plans have eased as I think companies have gotten more concerned about the outlook. So there are signs of things slowing, that the level of rates is having an impact on the economy. And by the second half of this year, as I said, we expect that GDP growth will be pretty close to flat. We have gains of around 0.5% after running, 3.5% to 4% over the last, 2 quarters.
Given the ECB, there's a piece in the Journal today about the job the Federal Reserve won't do, and that's to try to stabilize, currency fluctuations and foreign exchange. This just made it worse this week. In Asia, a strong dollar has already been sort of the story of the year, according to this. What do you think this gentleman who wrote this, it says he'd like better coordination, what is he saying? Is he saying it's our job, if we want to keep currency stable, to just follow the ECB, whether it makes sense for us or not? Is the Fed really supposed to be looking at that? That's the third mandate.
Right. No, I don't think that the Fed wants to be targeting, of course, any level of the currency of the dollar. It certainly feeds into their expectations, of course, about inflation. A weaker dollar would tend to put more upward pressure on inflation. A stronger dollar the other direction. So they certainly will pay attention to the dollar. You're right. At the moment, we've got the ECB, and we expect the Bank of England to follow suit, probably by the fall, while we don't think the Fed will cut rates till the end of the year. So there is a mistiming there that all else equal will put some downward pressure on the dollar. But our expectation as the U.S. economy slows that we are going to see more aggressive Fed rate cutting in 2025 that'll probably outpace both the ECB and the BOE. And so our expectation actually is that, the dollar, in 2025 will strengthen. I think the other thing, we don't have to get into it, is, of course, there's a lot of mixed views about the outcome of the election and what that might mean for the dollar.
Well, you haven't said anything that would cause anyone to feel uncomfortable with the stock market at these levels. And that's been one, I don't know about the underlying economy itself, but there's certainly been a lot of interest in financial assets and meme stocks and Bitcoin. So in that regard, it doesn't really look like we've been that restrictive. But everything you just said, it almost sounds like Goldilocks to me, Michelle. Soft landing. We get some cuts eventually, not too early. Things are not too hot, not too cold. Everything you're in a really good mood. Is it Friday or is it donut day? What is it?
It's donut day. It's Friday. In the sense that we are not looking at a hard landing, inflation is moving lower. It is an environment right now that looks pretty well, supportive for financial assets. Of course, one of the expectations is that as the Federal Reserve lowers interest rates, market rates will move lower. And I guess that's something that we need to see. Right now, you can see even in the last few weeks, we've seen 10-year Treasury yields moving lower, expectations about the economy cooling, giving the Fed room to cut rates. The question is whether or not we can get lower market rates following the Fed down, particularly against a backdrop of still a very expansionary fiscal policy and a lot of Treasury supply that needs to be digested. And so one of the things as I look ahead is that the market may have to be surprised, if you will, by the fact that even if the economy slows, we are not going to see the Federal Reserve going back into an easy posture. It's just about the Fed maybe getting to neutral. And we may not see longer term yields fall as dramatically as we typically do when the economy slows because of the fact that there is still a good deal of supply to be digested.